Every American owes a slice of a massive bill, whether they know it or not. The U.S. national debt has hit a staggering $37 trillion, and it is still climbing thanks to new legislation that could tack on trillions more. Compared to that, your credit card balance looks like pocket change. But what does having this huge amount of debt even mean? How does it even affect us? And would paying it off fix the problems in the economy? Or could it actually make things worse? We're looking into the world's biggest IOU on today's episode of the Infographic Show. What if the U.S. paid off its $37 trillion debt? To understand how to fix the debt, it's important to understand why we have it in the first place. There is an easy answer: lots and lots of government spending without enough tax money coming in to cover it all. And there's a more complicated answer, and that involves what the U.S. is spending government money on and why. First of all, the U.S. budget is divided into mandatory and discretionary spending. In 2024, about 47% of discretionary spending, or 14.8% of the total government budget, was diverted to spending on defense. Stockholm International Peace Research Institute, SIPRI, put total defense spending at $997 billion, while the congressional budget priced it in at $850 billion. Some items the SIPRI counts as defense spending, the CBO puts elsewhere in the budget. Just how massive is $37 trillion? Well, it's more than the combined defense budgets of the next 9 biggest military spenders, including China, which only spent $314 billion that same year. The U.S. drops a fortune on defense to stay the world's top military power, but that is not even the country's biggest expense. It is just the biggest slice of discretionary spending, the part of the budget that Congress votes on each year. In 2024, some of the biggest ticket items were Social Security, which totaled 22% of the total budget, $1.5 trillion, and Medicare, which was 12% of the budget at $839 billion. But Social Security falls under mandatory spending, which Congress legislates every so often for many years at a time. Mandatory spending is 2/3 of the annual budget, more or less depending on the year. The upside to mandatory spending is that it doesn't have to conform to pre-established budget limits set by Congress, as discretionary spending does. Well, it is supposed to, at least. Rather, programs that fall under mandatory spending usually have certain rules for who qualifies, and whoever does gets the money or benefits offered by the government. So in times of recession or any other national crisis, Congress doesn't have to scramble to suddenly allocate a lot more money to people. Instead, the people who need the government's help can get it immediately. The downside is, there is no telling how much the government will end up spending on those programs. The second biggest item, Medicare, falls under mandatory spending as well, while the Pentagon, which is discretionary, comes in third. Well, Medicare is usually the second biggest item on the U.S. budget. In 2024, there was a slight shift as the second biggest outlay in the U.S. budget ended up being interest payments on the national debt to the tune of $881 billion. Considering total U.S. government spending that year was $6.8 trillion, that means interest payments totaled almost 13% of the entire budget, and the Congressional Budget Office thinks that that number is going to get much worse. In 2025 alone, the CBO believes interest payments will total $952 billion, and by 2034, they could go up to as much as $1.7 trillion. Now, if you think this is a worst-case scenario projection, we have bad news. That is actually a decent-case scenario projection. The CBO forecast is based on the assumption that short-term interest rates will not only stay low but fall. If interest rates stay steady, or worse yet, rise, the U.S. will end up paying a lot more in interest costs. But how did the U.S. run up this enormous $37 trillion debt in the first place? In a very straightforward sense, the U.S. has accumulated an enormous debt by spending way more than it brings in each year. Some argue that it's because of lower tax rates, particularly for the richest Americans. Others say it's because of massive government spending, and both are kind of right. Because the U.S., like many Western countries, has an aging problem, Social Security payments have been increasing, while the labor force to sustain them is shrinking relative to the population. People are having fewer children and living longer than ever thanks to medical advancements. The U.S. population's median age increased from 30 in 1980 to 38.9 in 2022. Americans aged 65 and older, those who qualify for Social Security, are projected to increase from 58 million in 2022 to 82 million in 2050. That's an increase of 47%. On the other hand, according to the Pew Research Center, the U.S.'s working age population, age 18 to 64, will grow from 186 million in 2005 to 255 million in 2050. This is only a 37% growth over a much bigger period of time, and that represents a smaller rate of growth than that of the overall population. And there is one huge issue with that projection. Roughly 82% of the expected population growth is projected to come from immigration, not births. And that means if future policies restrict immigration, even this already slow growth in the working age population could stall out completely. If that happens, that is bad news for Social Security. There will be fewer workers paying in, more retirees cashing out, and a system under serious strain. Government spending in the last 2 decades also increased dramatically because of back-to-back crises in recent U.S. history, including the 2008 financial collapse and the 2020 pandemic recovery. In both cases, the administrations at the time passed massive stimulus packages to keep citizens and businesses financially afloat. In response to the financial crisis, the $700 billion Troubled Asset Relief Program, or TARP, was passed to stabilize financial institutions, and there was also the $787 billion American Recovery and Reinvestment Act, or ARRA, for aid, tax cuts, and infrastructure. According to usaspending.gov, since 2020, $4.7 trillion has been spent in response to the pandemic. This is a combination of funding for multiple agencies, including small businesses, labor, veterans affairs, and health programs, to name just a few. While government spending has surged to handle new programs and crises, taxes have steadily declined. In the early 1950s, the top marginal tax rate was 91%, meaning income above a certain threshold, about $200,000 then, or $2 million today, was taxed at that rate. But thanks to deductions and loopholes, the top 1% paid an effective tax rate of just 42%. In the early 2020s, the top marginal tax rate decreased to 37%, but the effective tax rate, the amount that the top 1% actually paid after deductions and loopholes, decreased 26 to 28%. So at times when the US government has needed money the most, it has been getting less than usual. In 2024, when the U.S. government spent $6.8 trillion, it brought in a total tax revenue of $4.9 trillion, a deficit of $1.9 trillion. This equates to spending an amount equal to 23.4% of GDP, while only bringing in an amount equal to only 17.1% of GDP. This spending to GDP ratio is important, for reasons we'll get into very soon. Even a third grader could look at those two numbers and realize that there is a problem, but it hardly started last year. From 1975 to 2024, the U.S. averaged a budget deficit of around 3.8%. But in 2020, that number skyrocketed to its highest level at 14.7%, driven by emergency spending during the pandemic to support individuals and businesses through lockdowns. And while deficits are the norm, there were rare moments of surplus, like under President Clinton when the economy was booming. The U.S. actually ran a 0.8% surplus in 1998, 1.3% in 1999, and 2.3% in 2000. The late 90s were arguably the last time the world didn't feel like it was on fire. The problem is the debt-to-GDP ratio has been accelerating exponentially in the last 15 years. In 2009, it increased to 75.8% in order to fight the last major financial crisis. While 75.8% might sound like an insanely high ratio, you should know that in 2012, the debt-to-GDP ratio hit 93.65%, and the debt-to-GDP ratio in 2024, according to Trading Economics, was 124.3%. So let's just pay it down then. Let's start saving, making extra payments, whatever's necessary, because right now the debt stands at around $106,637 per person in the US, which we're gonna bet is more than the average US person has in their bank account. Well, believe it or not, back in the optimistic days of 2000, people felt that there was a very real possibility of the US debt eventually being paid off, perhaps even as early as 2012. There had been a budget surplus for 3 years, and the total debt at the time was around $5.67 trillion, minimal and seemingly manageable compared to today's debt. But when economists started to model what might happen if the entire US debt was paid off, the results were kind of catastrophic. And not just for the US, but for the entire world. Because like a shopaholic, The US kinda needs that debt to function, since it's tied to US Treasury bonds. Treasury bonds are currently considered one of the safest investments in the world. So safe, in fact, that banks all over the globe buy hundreds of billions of dollars worth of Treasury bonds. They're considered a great place to hold money without losing it, and making some interest along the way. And not only banks all over the world, but institutions in the US as well. Because, as it turns out, over 2/3 of public US debt is held by domestic groups, totaling $20.3 trillion in holdings at the end of December 2024. These holders include the Federal Reserve, the largest holder of public debt overall, with $4.5 trillion held by them, and there's also mutual funds and pension funds, including Social Security, state and local governments, and insurance companies. In fact, Social Security is another big holder of national debt, almost $3 trillion of it. Because the money they get from workers and employers is invested into Treasury securities, they can earn interest and be kept safe until the people need to collect their Social Security payments. The largest foreign holders of U.S. debt include Japan, $1.062 trillion of U.S. debt, China, $759 billion, and the UK at $723 billion. It makes sense for the Federal Reserve to own most U.S. debt, as the Fed's job is to manage prices and inflation. It partly does this by controlling the supply of money via holding Treasury securities and determining interest rates. Within the U.S. itself, the interest rates on many things essential to a modern, well-functioning economy, like mortgage rates, are also tied to Treasury bonds' interest rates. Basically, the Fed buys and sells Treasury securities to achieve a certain federal funds rate that they have targeted, which is the interest rate at which banks lend to each other to meet their reserve requirements. The federal funds rate then becomes an unofficial minimum interest rate that each bank could set for their own loans to consumers and businesses. So basically, when you buy Treasury securities, you're buying off a piece of the U.S. debt. You're betting on the fact that the U.S. economy will stay strong and the country will keep on making its payments and not default. So if you pay off the national debt, you do away with Treasury securities entirely. You'll soon see why this is a much bigger problem than you think. But we first have to point out that there are definitely some upsides to paying off the debt. Most importantly, the U.S. could use that $881 billion that it pays in interest for other things, like schools, roads, and better social programs for its citizens. High national debt doesn't just hurt government balance sheets, it hits businesses too. As debt rises, interest rates follow, making it more expensive to borrow money. According to the Congressional Budget Office, for every $1 increase in the federal deficit, private investment drops by an average of 33 cents, with the range going as high as 50 cents depending on the industry. Paying down the debt wouldn't just balance the books, it could unlock a surge in business growth and investment across the country. As Stephen Kyle, Associate Professor of Applied Economics and Management at Cornell University says, if government debt gets bigger and bigger, interest rates are going to be going up, because deficits are a direct stimulus to the economy. The Federal Reserve will raise interest rates to keep inflation in check. And as we've shown, interest rates affect almost everything financially. The Yale Budget Lab did a study into the matter. They found that after 30 years, a permanent increase in the federal deficit equal to 1% of GDP would cause a $200 increase in annual car loan interest. But it gets worse. There would be a $2,300 increase on the average annual mortgage interest. The same study found that the 1% permanent deficit increase would raise inflation. The average U.S. household would lose $300 to $1,250 in purchasing power annually after 5 years of the deficit increase becoming permanent. Paying off national debt would thus decrease inflation, increase the U.S.'s creditworthiness, and increase investor confidence in the U.S. economy and dollar, thus strengthening the dollar globally. It may seem as though investor confidence in the U.S. is already at an all-time high. Currently, 90% of global foreign exchange transactions use the U.S. dollar, and half of global trade is invoiced in dollars because of its perceived strength and stability. The global use of the dollar in turn strengthens the U.S. economic growth and the equity wealth, as international credit and capital markets prefer to do business with U.S. companies. This occurs mostly because of the U.S.'s guarantees, known as full faith in credit. Wendy Edelberg, a senior economics fellow at the Brookings Institution, explains, full faith in credit basically is meant to give comfort to anyone lending to the U.S. government that the U.S. government will make good on those promises no matter what. It means loaning money to the United States is a safe bet. But economists tracking the U.S.'s future are worried that some global investors are starting to lose faith. In 2023, Fitch Ratings downgraded the U.S. credit rating, citing the growing national debt as a problem. The frequent fights in Congress about raising or refusing to raise the debt ceiling didn't help either. Refusing to raise the ceiling would basically mean default on some debt obligations, thus directly undermining the full faith in credit system. The downgrade was from AAA to AA+. In 2025, it was followed by a downgrade from Moody's, who changed the U.S.'s credit rating from AAA to AA1. This was a big blow to international perceptions of U.S. creditworthiness. Even though the downgrade was small, it was the first time that Moody's had rated the U.S. as anything less than perfect since 1917. And that's not the only worrying sign for global faith in the U.S. dollar. The dollar's share of global reserves has been steadily decreasing since a peak in the late 90s. In 1999, the dollar represented 70% of global reserves, while in 2024 it represented only 58%. The more investor confidence in the U.S. drops, the more interest rates on the debt rise. The more interest rates rise, the more unsustainable debt becomes for the country. And the closer the U.S. will come to defaulting on its debt every year, which will sink investor confidence even more. It'll be the beginning of a very vicious and very destructive cycle. Paying off the debt would likely immediately upgrade the U.S.'s credit rating, stop this cycle from happening, and reinforce global confidence in the future of the economy. But that is not taking into account the effects of how the debt will be paid off. There are two possible methods, or a combination of them, which would be very difficult for American citizens to bear. One would be to drastically lower government spending on anything but debt interest rates, and paying down the debt in general. And that means the government would need to gut major federal programs. And we're not just talking about cutting some red tape. That means slashing support for the sick, the elderly, public schools, hospitals, scientific research, roads, telecom infrastructure, basically the entire backbone of a functioning society. Not to mention the military would be majorly defunded. And given the state of the world right now, not having the strongest military might create a security risk for the country. The other possible response would be to raise taxes very high so that the money the U.S. government has available to pay down the debt increases substantially. Obviously, raising taxation to something like 60 or 70% for the entire population would be incredibly difficult for people, and that is assuming that taxes would be raised equally across the board, which is unlikely. Now, could the government just print a bunch more money? Sure, technically, but printing the amount of money necessary to pay off the entire U.S. debt would quickly cause inflation, which would spiral into hyperinflation. Other countries that have experienced hyperinflation, like Zimbabwe, ended up with paper currency that was so worthless they basically reverted back to a bartering system. In addition, thanks to the close relationship between U.S. debt and Treasury securities, most economists think that paying off the debt entirely is an atrociously bad idea in general. We would have to reconfigure the workings of the entire global economy and leave financial institutions without a reliable place in which to deposit their money. The last time the U.S. had zero debt was in 1835, and it lasted a total of 2 years. However, that was a time of much lower financial sophistication, less integration of global markets, and more poverty overall. Paying off the entire debt now would cause an avalanche of problems. For starters, what would the Fed use to manage inflation and unemployment? It could no longer sell securities. And what about Social Security and banks all over the world? What safe asset would they invest their consumers' and pensioners' money into if not U.S. Treasury securities? At the moment, no similar financial instrument or safe investment exists. Now the national debt careening out of control will also undermine Treasury securities. And that's why it's in our interest to lower the debt and not eliminate it entirely. As Professor Kyle says, that would be an international catastrophe for which there is no precedent for a major reserve currency of the world. We don't know exactly what would happen, but it won't be good. What's more important than the total amount of debt is the debt-to-GDP ratio. Though government debt and personal debt functions very differently in some ways, you still don't want to owe way more money than you make. And that's why the U.S. paid $345 billion in interest in 2020 and $659 billion in 2023, just 3 years later, and $892 billion in 2024, making U.S. payments for its debt interest higher than the entire U.S. military budget. The good news is, this doesn't appear that we're anywhere near the entire world losing full faith in the U.S. government's ability to keep up its debt payments or in the future of its economy. So it seems even the astronomical debt the country is in at the moment is okay for now. But there are some troubling signs on the horizon. For starters, 2025 was one of the first times that a shock to the stock market was followed by a decrease in the purchase of U.S. Treasury bonds. Normally, there's an increase. As former director of the Congressional Budget Office Douglas Holtz-Eakin states, this was basically unprecedented. Money fled from the U.S. for safety instead of to the U.S. for safety for the first time in my memory. See, people generally invest heavily in U.S. Treasury bonds in times of crisis because they're considered such a safe investment. So when the stock market is seen as volatile, people buy up bonds instead. Surprisingly, for most economists, that is not what happened this time, which may also explain why the US dollar keeps losing value against other currencies like the euro. And it may explain why 11 countries stopped using the US dollar as their reserve currency. All of that means, even though the US is still generally seen as a solid economy, international actors have lost some faith in the country's stability and future. And as multiple economists have warned, the debt isn't much of a problem until it is. And then it can suddenly become a huge one. Paying off the national debt might sound like a good idea, but there is a far darker scenario we can't ignore. Watch What If the US Economy Crashes to find out what happens when America goes broke, or click on this video instead.